In the space of just 18 months, the Bank of England has increased base rates from historical lows of close to 0 to 5%, with more expected soon. It's a really remarkable turnaround for an economy that got used to 13 years of ultra-low interest rates. And the rapid increase in interest rates has seen a soaring of mortgage costs and threatened to push the economy into recession. But after underestimating inflation last year, are the Bank of England now at risk of overcompensating in the opposite direction, pushing the economy into a deeper recession than is necessary? These are 7 reasons why the further increases in interest rates are likely to do more harm than good. Firstly, monetary policy is a bit like driving a car, where you only get to look out of the back window, and when you turn the steering wheel, it takes about 18 seconds to change the wheels. The time delay is very important. When you change interest rates, it takes a long time to actually affect the economy. If you increase interest rates, people may not remortgage for 2 or 5 years. So even going back to last month, June 2023, 56% of mortgage holders had not yet paid any higher mortgage payments, but they will do in the coming months as they remortgage. So the point is that most of the increase in interest rates that have already happened are yet to be fully felt in the economy. And the Bank of England's own data shows that over 1 million households are going to be paying an extra £500 a month pretty soon. And it's hard to underestimate just how significant this will be for the economy. It's the equivalent to, say, a 6p increase in the basic rate of income tax. It's going to really hit household finances very drastically. And it's not just mortgage holders who'll be affected by higher interest rates. It's firms taking out business investment and even renters who are indirectly influenced by the high interest rates. So all this is going to create very strong deflationary pressures on the economy. And yet the full effects of the recent rises have not yet materialised. And the problem is that rather than crashing into the war-marked inflation, the economy could crash into the war-marked recession. Secondly, inflation is finally starting to fall, and it will continue to fall over the next 12 months, pretty much whatever the Bank of England do. On the inflation front, there are some reasons to be cautiously optimistic. Firstly, food prices actually fell last month. The decline in oil and gas prices has been a real boon, leading to lower petrol prices. And although still very high, energy prices did fall slightly this month. Thirdly, we've seen rapid falls in inflation in Europe and the US, and China's close to deflation. And although it is true that the UK inflation performance has been one of the worst in the OECD, and may well continue for the next year or so, the UK does generally track trends in global inflation. So the fact that inflation is falling elsewhere will probably feed through into lower UK inflation too. Also, another reason to be cautiously optimistic, the recent rises in interest rates have caused something of a rebound in pound sterling. And this is good news because it makes imports cheaper. But again, it tends to depress demand, depresses export demand because British goods are less competitive. And all this, combined with the effect of higher interest rates and reducing spending and investment, is going to create a deflationary pressures in the economy. It will lead to slower economic growth, if not a recession, but also bring inflation down. Now, it is important to state that inflation is still a real problem. It's true the inflation rate is coming down, but a fall in the inflation rate can be slightly misleading. This graph shows the consumer price index and how much prices are going up. So prices are still rising, just at a slightly slower rate. It's exactly the same data, but gives a kind of different visual impression. Also, the Bank of England, in their defence, may point to high growth in nominal wages and also persistent underlying core inflation, which is quite slow to come down. All this gives a theoretical justification for high interest rates. But although there's a long way to go, the main point is that increasing interest rates now is not going to do too much to accelerate the decline in inflation. And there's a real diminishing return from higher rates with a prospect of higher unemployment if the economy is depressed too much. The third reason is that although we've had quite a significant rise in interest rates, it's important to bear in mind that these are even more powerful because, say, house prices are much more expensive than they were in the past. What this means is that if house prices are much higher, then the average mortgage balance is much higher too, so that even a small change in interest rates will have a very big impact on disposable income. I've mentioned this a few times in the past, but it's said that interest rates of 6% now is equivalent to raising interest rates to around 12-13% in the 1990s. And if you look at it from that perspective, we've effectively gone from zero interest rates to 12% in less than 2 years. That's a huge deflationary shock to the economy. And to understand this point, if we look at interest mortgage payments as a share of disposable income for first-time buyers, they are going back to levels last seen before the 1991 and 2009 recession. It's an important criteria for showing how consumers have been squeezed. And if the Bank of England do want to squeeze household income, they've really already done it, and do they need to do it anymore? And fourthly, we should never forget the really negative impact of a recession on the economy. The UK economy has already been stagnating for a couple of years, with growth well below the trend rate. And this shock increase in interest rates is further discouraging business investment, which has been sluggish for many years. And the risk is that it will cause a deep recession with rising unemployment. Now, it is important to bring down inflation. It would help to increase real wages. But we shouldn't obsess about the 2% target. The 2% target was brought in the 1990s, when conditions were much more favourable than they are now. There's no overwhelming academic consensus that this is the holy grail of target inflation. There are plenty of economists who argue that a better target may be around 3 to 4%, especially when the economy is recovering from the external shocks we've seen in recent years. So this is not to minimise the value of bringing inflation down, but the last thing workers need at the moment is an unnecessary recession and a rise in unemployment. The fifth reason to be concerned about the many rises in interest rates is that they are having an unequal effect within the economy. Higher interest rates particularly affecting the young and those on low and mid incomes, who are seeing higher mortgage payments, higher student loans, higher credit card payments, and perhaps indirectly higher rent. Those who have paid off their mortgage are relatively unaffected. And although real interest rates are still negative, with inflation higher than interest rates, savers are seeing higher nominal interest income. Now, the unequal effect of interest rates is a limitation of monetary policy, and there's not too much, say, the Bank of England can do about it. But it is worth bearing in mind that the Bank of England is being helped to some extent by UK fiscal policy. UK tax rates have been increased in recent years, one of the highest historical levels, and the freezing of income tax thresholds are in effect increasing income tax rates, making people pay more. So that's another deflationary effect through fiscal policy, in addition to all the higher interest rates. Another reason to be concerned about all the interest rate rises we're seeing is that some people do fear that the motivation for the rapid rise in interest rates is at least partly down to the Bank of England's attempt to restore credibility. Unfortunately, their predictions of inflation were out of track. They consistently underforecast inflation, and it proved higher than expected. Now, this was partly due to things outside their control, like higher oil and gas prices, but also their models were underestimating second-round effects on nominal wages and the service sector. But the concern is that they're kind of going from one extreme to the other. Because they underestimated inflation, they're now increasingly determined to bring it down and forget about their other obligations, which is to consider the wider economy and employment. The seventh and final reason to be concerned about higher interest rates is that they're causing a fall in house prices. Now, in the long term, you could argue this has benefits for affordability, but in the short term at least, falling house prices will be another factor causing lower spending as people worry about declines in wealth and the effect on equity withdrawal going into reverse. And this is yet another thing that will slow down the economy. Now, of course, it's always easier to criticise the Bank of England or policy makers. I don't particularly envy their job. It is a difficult trade-off. But even so, I do feel that it's a mistake to raise interest rates so much. At this point in time, it'd be better to wait and see the impact of their past rate increases, because there's a danger of going too much the other way and causing a recession that's deeper than necessary, which will have damaging economic and social consequences. If you like this video, please give it a thumbs up and subscribe to the channel. And you may also be interested in this video here about the impact of falling house prices on the economy and why it's so important in the UK.